This is InvestTalk. Independent thinking, shared success.
Hi, first off, just want to congratulate Luke on his Eagles win. Also want to congratulate Justin on his trade for Luka, the Lakers getting him. I wanted to have a question today about ticker DXPE. Wondering if you think this company is worth buying right now, if you think it's overvalued, or if you can find me a good entry point, see if the stock is worth owning. Thank you very much. Have a good day.
Well, thank you, first and foremost. I did not do much for that victory. I just drank margaritas and watched and supported. But this show is not about the Eagles, though I wish it was. It's about answering your questions, so we'll dive right in. And this first question is on DXPE, that is DXP Enterprises. It is a distributor of maintenance, repair, and operation products and services. They cater to a diverse range of industries, including oil and gas, food and beverage, water and wastewater, chemical transportation, aerospace. It's an old company, headquartered in Texas, founded in 1908, over 100 years old. Now, even though it is that old, it is not particularly large. It is a $1.5 billion market cap company that has a little bit of debt, about $575 million worth of debt. Now, even though it has about a third of its market cap worth of debt, its interest coverage ratio is a little lower than I like to see at first glance, about 2.71 times. Again, that means that the earnings they make before interest and taxes can cover their interest expense 2.71 times over. So anything under than one, you're in a little bit of trouble. And as you get closer to one, well, maybe that is a flag, but we don't know yet. Now, its cash flow has kind of been all over the place over the past 5 years, but trending in the right direction since the beginning of 2023, as is profitability for this name. Now, they lost money in 2020, a lot of companies did. But heading out of the pandemic, their margins started to creep back up a bit and even go higher than pre-pandemic levels. In 2019, their net margin was 2.8%. In 2023, that number was 4.1%. It is supposed to come down a little bit to 3.6% as of fiscal year 2024, earnings of which shall be announced on March 6th, and then stay steady, about 3.8% the following year. In terms of performance, it has had a banger of a 52 weeks. It is up 194% over the past 52 weeks, up 46.9% over the past 3 months, up 23% year to date. And one of the reasons why is because they had some pretty stellar earnings in their most recent announcement. In the latest quarter, company reported revenue of $472.94 million, surpassing their estimated $443. Their net income for the quarter also increased 26.41% over the previous year. And so anytime you have not only good forward-looking guidance, but solid performance that beats consensus, well, your company is probably going to do particularly well. They announced a strategic acquisition in early February of this year, aimed at enhancing their product offerings and expanding their market presence. So their growth through acquisition strategy is pretty solid, especially given the fact that they've paid down their debt in the past year. So they're not issuing more debt for these acquisitions as of yet. Now, their free cash flow, as I mentioned, has improved, and it went from about $1 billion in free cash flow to about $94 billion last year. Not much growth into this year. You see it's flatlined a little bit. And so with this run up, the question is it overvalued? Well, it's trading about 22.3 times forward-looking earnings. It's trading about 0.9 times sales, so not even 1 time sales. It's high over the past 5 years was 1 time sales. With respect to its average and forward-looking earnings, well, it's about where it has been over the past 5 years. Growth looks solid, as I mentioned, 6.7% on an annualized basis, and very solid growth coming out of the pandemic. Over 60% in 2 years, from 2021 to 2023, and that growth doesn't seem to be slowing down at all. And so with that in mind, one thing I want to look at one more time is geographically, how's it split up? 95% of its business in the United States, 4% in Canada. So it certainly wouldn't be a candidate for suffering from external tariff pressure. And so given its strong market position and its uptrend, I mean, its momentum is undeniable here. Since November, it had a huge pop at its last earnings at the end of October. And since then, it's trailed upwards, up and up and up. And so, I'm sorry, that wasn't its last earnings. Its last earnings was in December. But it's trailed upwards since then, up and about from $50 a share in October to $100 now. And so the question was, is it too expensive? I think it's probably about fairly valued. It is where it is over the past, or has been rather, over the past 5 years. And given that its growth looks pretty solid and its profitability does as well, I'm going to give this a thumbs up. That's DXPE Enterprises, ticker DXPE. Let's go to Dan from Walnut Creek, who has a question about CDs. And I imagine you're talking about certificates of deposit and not those things that play music in your car.
Exactly. Hey, Luke, thanks for taking my call.
Yeah, thanks for calling. How can I help you?
Yeah, and I'm not calling about 8-track tapes either.
Fair enough. Fair enough.
Hey, so I'm 71 years old. I have a large part of my savings in my brokerage account. About 2/3 of that brokerage account is made up of individual stocks in ETFs, and about the other third is in brokerage CDs that are spread over about a 5-year period. I'm looking at moving more of my cash, or selling more of my stocks and purchasing more CDs. And I was looking at selling off AVUV and VTWO and purchasing a 5-year brokerage account at 4.25%. And I was thinking that the two ETFs that I have that I was talking about, I'm not too sure how well they'll do in the high interest environment. So I wanted to get your thoughts.
Yeah, so it looks like they are both small cap ETFs. AVUV, Avantis, we've talked about those a lot. You know, the guys I used to work with started that company. They're good managers. It is a small cap value fund. So what they tend to do there is they tend to tilt to the value side of the market and also have an emphasis on profitability. And so if you were not as experienced in age, let's say, as you are, and you were on the younger side, I would say, you know, historically, over longer periods of time, small cap names, value names tend to do better over the entire sample. And the longer you stay invested in them, the higher the probability of higher expected returns you have. Now, you're in your 70s, as you said, and I guess the first question is what is this money for? Is it funding your lifestyle? Because, you know, CDs, for those of you who don't know, listening at home or watching on YouTube, they have limited liquidity, they have lockup periods. So what's the purpose of this account that you're thinking of shifting over into CDs?
Mainly just savings. Right now I'm able to live off of my Social Security and some other money I have coming in. Just mainly to keep it safe.
Yeah, I think that's entirely fair. I think that if you're going to sell down on small cap and value names, particularly in a year like this where interest rates may be going up, the cost of capital may be going up, they can be outsized and adversely affected compared to large caps with respect to the cost increases of tariffs and price hikes that a lot of companies, the larger companies, can just swallow. And for those reasons, it could be that, you know, small cap value names suffer over the next 6 months to a year. What I would say warn you about, though, with these CDs is, at the same time, if you expect, as I do, interest rates to remain sticky or maybe even move higher, by locking in this rate now, you may find yourself in an opportunity where 2-3 months from now, you're missing out on yield compared to the prevailing yield of short-term or medium-term treasuries in the market. And so that would be the only thing that I'm concerned about. I think your inclination to take away from your exposure in small value names makes sense to me. I would just remind you some of the pitfalls of CDs, i.e., yes, they're low risk, yes, they're fixed rate, but they have very limited liquidity. Sometimes they have penalties if you want to take it out. So if you need that money, you can't. But also, yeah, you're getting a yield, but it may not keep up with inflation. So I would just keep that in mind. Historically, over long periods of time, equities tend to do better than bonds and CDs for inflation. Commodities tend to do better. Real estate tends to do better. So I like where you're thinking in terms of the part of your portfolio you're going to divest from a little bit, but just wanted to make sure you're aware of some of those risks. Hope that helped.
Yeah, I've got that. Thanks very much. Yeah, and I've laddered some CDs and
great.
As far as bond. So I appreciate the help.
Yeah, very smart. Well done. Good job, Dan. Thanks for calling. Looks like we got another live call. Robert from Pleasanton, listening on AM 1220 KDOW. You have a question about FMC. Do you own it or are you looking to buy it?
Oh, hey there, Luke. Happy Valentine's Day to you.
Why, thank you. Happy Valentine's Day to you.
Yes, thanks. I do not own it, but I've been looking at it, especially since it took this big drop earlier this month, and just curious if you think that this is the classic falling knife situation, or are we at a point where it might be a good time to start picking up some shares?
Yeah, well, let's take a look at it. So FMC is FMC Corporation. It's an agricultural sciences company. They help provide solutions to growers and development of pipeline and crop protection, plant health, agriculture, pest control, all the things that help make croppers' lives easier. Now, it's a small mid cap name, $4.582 billion market cap. It's got quite a bit of debt, $3.365 billion, but still its interest coverage ratio is 5.71 times, and that's an improvement on the past couple years, so certainly some improvement there. Now, on the profitability side, this could be one of the reasons why it's down so much, and that's because profit margins have just been slipping. They peaked out in 2021 at 15.9%, down all the way to 9.5%, though set to stabilize around 10% this upcoming year. And that's some pretty fresh data that explains why there was that big drop-off in price in early February, right? They reported earnings on February 4th, 2025, and what those earnings showed is not only are profits slipping, but revenues continuing to slip. Their peak revenue was about $5.8 billion in 2022. Since then, it's fallen all the way to $4.2 billion, and it's projected to fall again headed into next year. Top line has fallen, bottom line has fallen, everything in between, as you see right here, is falling as well. And so that makes sense to me why year to date it's down 24%. 52-week, it's down 28%. On the 3-month, it's down 33%. It also explains why it's yielding, what's its dividend yield now? 6.32%, which is 6 times where it was in 2022, double what it was in 2023, and certainly bigger than it was last year. And so you look at this and you say, well, it's trading at 10 times forward-looking earnings. It's trading at its book value. It's trading pretty much at its sales value. But I would say, given this steep drop-off and breaking a trend that didn't really look good in the first place, right? It was kind of just stagnating for a really long time. I think it's too early to say if now is a good buy point. I don't like companies that are cheap that also have shrinking profit margins and narrowing growth on the revenue front as well. So for me, I would stay out of this name. It's tough to say if it's really consolidating because this happened too early. Certainly the market's still digesting it, but you know what? For what it's worth, still 5% short interest. So I'm going to have to pass. Let's get a fresh question in from the comment section of our InvestTalk YouTube channel. This one coming in from our friend Greeg08, one of my favorite names of anybody who consistently comments on our YouTube channel. This question is about ECPG, ticker ECPG. It says, you've mentioned on the show that defaults are increasing, albeit from historically low levels. Glad you're listening. And credit card debt is increasing across the board. Given that backdrop, would it be prudent to get in now to Encore Capital? It has some decent price levels. Should I get in before collection trends ramp up significantly? So as I mentioned, ticker ECPG, Encore Capital Group, Inc. is a specialty finance company that provides debt recovery solutions for consumers and property owners across a broad range of financial assets. What they do, essentially, is they purchase portfolios of defaulted consumer receivables at deep discounts to face value and works with individuals as they repay those obligations and work towards financial recovery. Now, over the past 52 weeks, it is about as flat can be without being exactly zero, up 40 basis points in the past year, up 4.67% year to date, up 3.33% over the past 3 months. Now, in terms of its revenue, it has fallen even as defaults start to increase over the past year. So it did rise a little bit. It's still not reached the pandemic high of $1.572 billion, though it is projected to increase to $1.424 billion as of the reporting, which comes on February 26th, and increase again next year. Their margins expanding off of their loss in 2023, about negative 17% net margin in 2023, projected to be 8.7% in 2024. Again, we'll find out at the end of February. and then grow again to 11.3% next year. In terms of price to book value, trading at 1.1 times, forward-looking price to earnings 6.4 times, price to sales trading below at 0.9 times price to sales. And so I do like where your head is in terms of thinking of the underlying trends that could drive markets. It's not just about debt increasing, right? We're already seeing the signs of pared back spending. You have January retail sales figure lower than expected. You have inflation starting to pick up again. You seemingly have an administration who's not too worried about the inflationary ramifications of their policy, which could again stretch wallets, lead to more defaults. And you could see growth head in the positive direction once again, right? They're projected to have a high of revenue in 2025. Now it's a small company, $1.1 billion market cap company, about $3.5 billion in debt. Cash flow though is falling, I would say pretty steadily. Even going into the pandemic, it's fallen off. Earnings have been pretty stable. I think this could be a situation where I wouldn't consider this a big buy right now. I also wouldn't consider it a sell. I would consider this a wait and see. I think one of the issues here is that this is one of those trades where being too early can make you miss out on some other opportunities. So even though it's trading at a reasonable valuation, I haven't seen signs of a greatly weakening economy enough to make me think that this is going to dramatically outperform other areas of the market. So for now, I would hold on. Certainly, if this is your thesis, today was a good day for it, given retail sales figures. I'd wait to see a little bit more data in the coming months that would really prove out what may happen with this name. That is Encore Capital Group, ticker ECPG. Looks like we got a call from Taylor, who is live in Santa Monica, where I used to live for 6 years. How can I help you?
Hey, Luke. I had a question about a real estate fund.
Okay. What's the ticker?
It is VNQ.
The Vanguard Real Estate Fund.
Yeah, I want to get some exposure to real estate. I guess my other question for you would be, do you think real estate is an area of the market that's a little maybe more undervalued compared to like large cap tech or something like that?
Well, I think most areas of the market are undervalued relative to large cap tech. I think it's also always good to have some exposure to real estate because real estate tends to do better in higher inflationary environments and stable rate environments. Not necessarily when rates are coming down, but at least when there is a clear path of where rates are headed. And so if you are worried about inflation, and we've been saying for some time that inflation is likely to be higher than it has been over the past decade, and it's going to be stickier as it is proving out to be, then having exposure to real estate is probably a good idea. Now, some people think of their exposure in multiple ways. I have friends who are, talking to me about buying homes, buying investment properties. And I always say, well, that sounds pretty illiquid to me. And so REITs are a really good way to get into the real estate space. And I think, like you said, sure, it's undervalued relative to tech, but I think it's at pretty good valuations because it hasn't really run up that much over the past, several months, right? And so taking a look at VNQ. VNQ is a Vanguard fund. It's a cap-weighted, passively managed fund. Essentially, all they're doing is they're taking a look at the real estate sector and investing in a market cap-weighted basis. That's why it has 158 names. Certainly, it's a little bit top-heavy. You've heard of some of these names that we've talked about on the show before, probably Digital Realty, Prologis. They actually have a pretty high cash right now, which is interesting to me, but we'll step aside from that. They're at about 15% cash right now. But if you're trying to get into the real estate space and you're not trying to be active, you're trying to be passive, Vanguard funds are always a good way to go for really the primary reason that they're very cheap. 13 basis points. You're getting exactly what I think you're looking for, which is real estate exposure. So if you're trying to get some, I think VNQ is a good way to go about it. Thanks for the call. Now it's Friday, my favorite day. And on Fridays, we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.25% today. For perspective, last week it was at 4.285%. 29 weeks back, it was at 3.882, and 67 weeks ago, it was 5.05. The 10-year yield was at 4.472% today. For perspective, last week it was 4.491%. 25 weeks ago, it was 3.921, and 67 weeks back, it was 4.63. Gold was priced at $2,883 per ounce today. Last week, that was $2,859. 66 weeks ago, it was $1,935. And 155 weeks ago, it was $1,806. Silver today was priced at $32.27 per ounce. Last week, it was $31.84. And 53 weeks ago, it was $22.80. Oil was selling at $70.75 per barrel. This is a decrease of only 26 cents compared with last week. 21 weeks back, it was $67.79, and 63 weeks ago, it was $74.30. The national average for a gallon of regular gasoline is $3.16, a 2-cent increase compared with its price last week. 89 weeks ago, that number was $3.56, and 137 weeks ago, that number was $4.25. In California, it was averaging $4.54 per gallon, a 28-cent increase over last week. 67 weeks back, the number was $5.32. 143 weeks ago, the number was $5.87. For comparison, in Kentucky, gas was averaging $2.82 per gallon today. That is $1.72 less per gallon than gas in California. Well, you guys really took what I said to heart, and you are calling in rapidly. Let's go to Sammy in San Francisco, who has a question about Micron and was listening on AM 1220.
Hey, thanks for taking my call.
Hey, Sammy.
I would like to get your views on Micron. MU is the symbol. Do you think it's a good time to get in or to wait?
Yeah, so Micron is a name that we actually hold for clients in one of our strategies. I think we originally bought in, I want to say maybe in 2023 in like the 60-ish range. Sold a little bit when it got really, really high in like the 120s. We didn't hit the exact top, but we started to buy again back in the high 80s. Now, Micron, I think, is great because it is one of those names that is involved within the AI secular growth theme, specifically within memory and storage, but it's also not at really high valuations, right? They only trade at 10.8 times forward-looking earnings. They only trade at 10 times cash flow. They only trade at 2.3 times their book value. It's a $106 billion company with very minimal debt, only about $14.4 billion in debt. Its cash flow, though dropping off from its 2022 highs, starting to improve again, as are its profitability, right? It was kind of negative profits in 2023 and 2024. And so we get calls about this name a lot, and I kind of always say the same thing, which is anytime you are looking at a company that is in a area of the market that tends to be highly volatile, it only makes sense for you if you can stomach the volatility, right? Over the past year, it's only up 21%, but year to date, it's up 18%. And so this is an incredibly volatile name. You see these volume spikes pretty much every 3 months with a change in market sentiment about this name. For me, I think this is a good way to get into the secular driver of growth that we've seen over the past couple of years without purchasing some of those names that are incredibly, incredibly high valued. So for right now, I still think Micron is a good company. We do still hold it for clients. Thanks for the call.
Hi, InvestTalk. This is Matt calling from Tel Aviv. I have a question regarding Abercrombie & Fitch, ticker symbol ANF. I can see that they make money. I don't know about their debt situation. I know their management has been better in the past few years. I know definitely me and my friends are back shopping there after a break of 10 years. So I wanted to know if you're excited about it in the current price, or should I wait to see if it goes down a bit? Thank you very much. Love your show, and I'll listen every day.
Well, greetings over there in Tel Aviv. Let's dive into ANF, which is Abercrombie & Fitch. And this is an interesting company because you weren't the only one that took a 10-year break. But over the past couple years, really coming out of the pandemic, there was a huge brand resurgence. It rebranded itself towards more inclusivity and quality and a wider array of products that had higher margins, really targeting Gen Z consumers and millennials. And because of that, it returned 285% in 2023. In 2024, stock was up 69.4%. And so what you're seeing here is a necessary pullback, down 25% year to date, down 6% over the past 52 weeks, down 22% over the past 3 months. But income has grown. Again, high margin, shifting to high margin businesses. From losing money in 2021, projected to have a net margin of 11.5%. Again, we'll find this out on March 5th when they report earnings. But still, moving from negative to double digits net margins in the clothing retail space in that amount of time is a pretty solid turnaround. They had leadership changes. They had a former CEO, was the CEO, someone within leadership was arrested on charges of not so good things. But revenue's really grown. Profits have really expanded. I think it's a good company that has a pretty solid turnaround story. Now it's trading at 9.6 times earnings, which is certainly low. It's trading at 1.2 times sales at price to book value of 4.4. So fundamentally, with its $945 million of debt on a $5.5 billion market cap company, fundamentally with its solid growth and increase in cash flows, I think it's a good company to buy. But from a momentum perspective, from a technical perspective, it doesn't look too great. It's been on a downtrend for a couple months now. It's hitting its support level of about 110. It could go below that. Certainly the market thinks it might. It's got 9.39% short interest out there. They've been buying back shares. I like that too. I like a lot of things about this company, but what the market is telling you right now is it's likely to head lower. So for now, I'd hold off buying. Maybe you'll get a better price. Thanks for the call. Now, one last story before we head off into this long weekend, that is on the Trump administration's focus on containing long-term U.S. Treasury yields and how that has sparked expectations of regulatory reforms that could ease leverage requirements for banks, particularly through changes to the supplementary leverage ratio, also known in the industry as the SLR. Now, this rule, introduced after the 2008 financial crisis, requires major banks to hold extra capital against their holdings of U.S. Treasuries and central bank deposits. A revision of this rule could allow banks to move more or hold more treasuries rather without additional capital requirements, potentially boosting demand. And when more people are demanding U.S. treasuries, well, that drives yields down. Now, investors and financial institutions are already reacting to these signals. Swap spreads have widened, indicating expectations that the review is likely on the horizon. The shift in policy focus comes as the U.S. Treasury Department and regulators seek ways to improve liquidity in treasury markets amid what we all know is rising government debt issuances. Federal Reserve Chair Jerome Powell and FDIC officials have recently expressed support for revisiting this rule, reinforcing these expectations that changes might be imminent. For investors, these potential reforms carry several key implications. Yes, it could lower yields. Yes, it could float growth stocks. Yes, it could do well for real estate. But you have to remember these rules were put in place in order to prevent what happened before. And so even though there are some benefits, as always, be aware of the risks. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And while you're over there, please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go over to investtalk.com and click the portfolio review button. This is a free and confidential service. And while you're talking with us, while we're reviewing your portfolio, understand that we can also help you optimize the potential of your 401k. It all starts at investtalk.com. Remember, we play a best of show on Monday. The market will be closed for the holiday. I hope you enjoy this restful long weekend. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.